at first, I like you've been going through a lot of stuff, but the first thing that really got me was the whole private credit, private equity kind of thing, because you, with one of those articles, had found something that had been my niggling point from several months back when it was first announced by the Trump administration that they were going to get people's 401ks into private equity. And I was like, say what, bitch? So maybe you can give us a little background on that to kind of intro us from one subject to the next and kind of get us into that.
Yeah, so when that came out, I was with you. Um, I've always kind of had this disdain for private markets just because like I hear the reasoning and I see on how untested it is. It's like these are liquid assets, therefore you get paid more to have them. And it's like, okay, but how much money has flown into those sectors? How big up are they? And for a long time, it's been like, oh, private equity is the way to be. Oh, you want to go into private equity? Like, there's a lot of talent in my generation that's gone that way. Mm-hmm. Then they start going into 401ks, and it's like, well, why? And sort of what I've discovered, and I have a website called Market to Fantasy that I built, is like all of the institutions are fully allocated, like over allocated. So if you run out of institutions, private credit specifically, and I'll get into it, is completely capped out on insurance companies. Surprisingly, like some people don't understand what's happening.
There's a company buyout that I'm in right now where I'm pretty sure it's going to get buyout, but it's a private equity buyout of a public insurance company. So exactly. I mean, I know exactly what you're talking about.
And that's because it's captive capital. Like Warren Buffett bought Berkshire. He was able to take the money, figure out the risk, take some risk, hit some home runs inside of an insurance company and make it into basically a holding company, because you have to have deposits. What Apollo started doing in 2009, they co-founded Athene, and then they're like, we have great ways to make money. Like, let me tell you. So they start offering 6% plus annuities. And, at the time, like
oil, whatever it is.
No, yeah. Okay. Yeah, not oil annuities, but like, the risk-free rate has fluctuated. I'm sure, during COVID, it went down to 4 or 5 or something, but it's consistently above corporate bonds and it's consistently above treasuries. So all of the insurance companies are like, what is Athene doing that they can do that? And there's been a risk creep. And there's been a story that there's less risk than investment grade corporate bonds because they're secured. But if you look at recovery rates on the top of the top first lien, it's gone from 70 cents, which is still not safer than corporates. Corporates don't rarely ever default. Investment grade, they go into high yield and then high yield rarely defaults, maybe, but Ares has this slide from last year where they say it's safer, better risk adjusted returns because it's just been good times, It's right. Like we went through COVID since 2009. Like COVID really, was like the only crisis, and all of a sudden Fed prints and it's fine. But what happened is rates actually went up in 22. They're still much more elevated than they were in the prior period. And you have all of these companies that are on variable rates, just like real estate, REITs had a run on REITs. Mm-hmm. So I came out with an article just sensing it was a good time, that these guys are not investors. They do not look at a business and say, what are the cash flows? What is the dynamics of this business? Kind of like, Warren Buffett side up. They've completely bastardized it. And they're like, what are the comps? What is the exit? What do these things go for? And my whole point is what do they go for? What should they go for?
Right.
These guys are always talking about age. And the thing is, if each of us buy an HVAC company and compare our marks to each other's marks, and then we sell them to each other and we keep on bidding them up.
Oh, be careful about this analogy. You're going to trigger Bill Pulte.
What do they go for? What did the tulip go for in the 1600s? It's, if you're just saying what is this thing going for now? Fine. I'm fine. That's what it goes for. But you're doing 5-year loans. So what will it go for? And what are your assumptions to justify that? So I've divin, whatever the word is.
Dove.
I've dived in,
There you
and it's like really the main use of private credit is leveraged buyouts by private equity. So these guys are buying HVAC companies at 15 times EBITDA and putting.
Wait, this is like literally Bill Pulte's whole business model.
I thought it was real estate, but yeah, I mean,
No, he was buying HVAC companies.
Right. So
his little private equity firm that he has, that's
Yeah,
the reason why he's
Capital.
supposedly so rich, is a bunch of what you just described. That and trailer parks that are literally like slumlord trailer parks.
Yeah.
Right.
Okay. Bill Pulte has nothing to do with PHN, just for the record. His lot in life was to do exactly what you're talking about with HVAC companies.
The current FHFA director.
Yeah.
Yeah. Yeah. So it's a lot of financial engineering. They'll put, 40% LTV on it. And it sounds okay. It's like, when I think of debt, I want to think about debt to assets. I want to think about how much cash does it have and what is the liquidation value of the property, plant, and equipment inventory at fire sale. That is how I think credit was normally done. I haven't been alive for 100 years, but that's what I would assume. And these guys are LTV, and it 30 for 40% LTV. It's not that levered. And it's but wait a minute, you're paying 15 times EBITDA. So, if it's 33% LTV, you are 5 times levered on the EBITDA. And then you go to the EBITDA and it's adjusted, because what they say is, because we're buying all of these HVAC companies, there's going to be synergies. They love the word synergies. And then they mark up the EBITDA, and then they sell the best real asset you can have, which is the property, and they don't add it back. They do all of this insane financial engineering. And then they go out and buy it like a smaller HVAC company. It's $5 million in EBITDA, their fake EBITDA. And they only pay, I don't know, 7 times for it. But it's literally one man and his team that go into it a suburb, a suburban area.
Right.
And they're ooh, because we're going to buy it at 7, then we're going to put it at 15. There's EBITDA arbitrage. We're going to tell people we have this ROI, and then everyone's look, it's just this frenzy. It just makes literally no sense if you actually think about it and you start poking holes in it. And I kind of like the pushback that I get on social media for asking questions. I'm just why, so that's led to a series of articles on it and some good social media attention. It's going after Josh Cohn is one thing. He's a small, he's just it's literally fun. But then when you're going after a $9.5 trillion private equity market and a 3.5, 1.8 is in BDCs, publicly traded by retail, that's that's not little fries. That's big fries.
Right.
And then just going back to the point, it's this is all built up from money flowing in, and pensions. Norway was no, we'll buy public equities. They're the only one. All these sovereign wealth funds, and
I mean, that's the thing that Saudi Arabia got it in trouble with their sovereign wealth fund, with things like WeWork and things like that, where inflated valuations got ahead of what actually was going on.
And they lever up into it. Saudi Arabia, because they're Saudi Arabia, they're able to get, buy a treasury, lever up on it 10 times, rehypothecation, put it into a private equity fund, have the cash flows of Aramco. So it's the amount of leverage that's actually in this is unknowable, but I can assure you it's higher than people think. But they ran out.
They're starting to figure it out, because I was telling you, the options flow in HYG last week was insane.
Right. Which is the public version of these companies. But you got to understand, in order to be an HYG, you have to be public and have access to public capital and have access to public debt markets. The
Right.
types of companies that are private for the most part could never get, go to debt capital markets and public markets and get any money,
Right.
at all. So they go to these private markets, but it's been like there's been so much money that's gone into it, and it's reliant on that. All of the private equity multiples, and if the private equity multiples go down, like the debt becomes harder to justify because the multiple, what does it go for, goes down. So they got to a point where they're like, we need more money. We can't go to any more pensions. We can't go to any more insurance funds. We already have all the sovereign wealth funds. Norway won't listen to us. We're capped out. And then you see areas like they go to Japan and they're like, we can help you with retirement. They go to 401ks and they're like, the retail investor, we have a great product, the retail investor, they need help with their retirement. Like they should, we should democratize access to this product. And they went into 401ks. This is at the top of the cycle that started in 2009, right? There's been no really private credit downturn. Private
in spite of some really big LBO blowups like Toys R Us, Caesars, or formerly known as Harris.
Right. But then they show you the aggregate and they say it's all good, but they don't mark it down when times are bad. And for 2 years, there's been horrific exits. And the thing is, they said originally it was Lina Khan and the FCC. When Trump comes in, it's going to be all better. Trump comes in and all of a sudden it's not better. And they're like, it's the tariffs. As soon as the tariffs go away, it's going to be all better. They come into 2026 and they're like, this is our year. Exits, exits, exits. M&A exits, M&A exits. And they ran into a buzzsaw. They ran into a literal buzzsaw. While the economy is accelerating, it got revised down, so not as much as we thought. We have credit crunch happening. So what you imagine with Toys R Us, all of, that was an outlier. You can look at that being consistent and the norm going forward. There's been a whole bunch of stuff. And the thing is, now it's in retail 401k accounts that they can actually see. And that's when it becomes different, because they dumped the worst assets onto retail. They didn't take the best loans from sovereign wealth funds and go, here, Mr. John, who's 50 years old in Missouri. No, they took the worst, they took the highest risk, and the insurance companies are fully exposed to this. And I think, if you look at the mechanism, I think that a lot of them are going to go under and we're going to have bailouts. But the thing is, a bailout receivership for a bank or for an insurance company, that's like Silicon Valley Bank. They forget about it. It's when these things blow up, and it's your equivalent. I think you can actually probably buy it on Robinhood, but Fidelity or Schwab or whatever, when a voter can see it affecting them, that's when there's going to be regulations and change. And I've just been sort of diving into this, causing a little bit of a ruckus, because I think it's something that people should understand. We're going to pay for it. It might not even be me. It might be my kids. Like the Trump account, everyone's born with $1,000 or $2,000. It's going to be like a new kid's born with $1 million in debt. That's where I think this is going. Anyway.
That's really interesting and really doomery about. That's a good point, Amy.